It's funny how our everyday lives are just packed with legal stuff we barely notice. Like, think about signing a new phone contract, all that tiny print, right? Or even just buying a coffee, that simple buy-sell thing. It connects you to this whole invisible web of legal structures. So today we're diving deep into these sources you shared with us, a really fantastic guide to some core legal ideas. Our mission, simple. We want to be your shortcut to understanding the essential legal architecture that underpins your financial life. We're going to cut through the jargon, pull out the really important bits, and help you grasp everything from how businesses are set up to how your assets get protected and passed on, all without making your head spin. Think of it as, your guide to getting genuinely well-informed. Might even uncover a few surprises. Okay, let's get into it. Starting with a concept that sounds super formal, but is actually, well, fundamental. What exactly is a legal person?
Right. And it's interesting because a legal person isn't always a human being, is it? It's anybody. Really could be an individual, could be a company, even a trust that the law recognizes having its own existence. That means it can do things like enter into contracts, own property, sue someone, or importantly, be sued in court. The key thing is this idea of a distinct legal identity. That's what legal personhood gives you, or your business.
Okay, so it's not just people.
Exactly.
And that distinction matters hugely for you, the listener, because it really dictates who's on the hook for what, especially in business, and how things are owned and managed. It's like the bedrock.
It really is.
So let's take that idea, that sort of abstract legal person, and see how it works in practice. Let's talk business structures. If you're thinking about starting something or even just dealing with businesses day to day, understanding this stuff is, well, it's crucial for knowing the risks involved. Let's start simple. Sole traders.
Okay, sole traders. The absolute key takeaway here. The owner and the business are not separate legal persons. They're one and the same in the eyes of the law, which means no legal shield. The owner is personally liable for all the business debts.
Wow. So if the business owes money, your personal savings, even your house.
Potentially, yes, they could be at risk. And any profits the business makes, that's just treated as your personal income for tax purposes. Very straightforward, but high personal risk.
Right. That's a world away from how a company operates, isn't it? That feels much more separate.
Totally different beast. Companies are considered a distinct legal person or legal entity, completely separate from the people who own shares in them or the people who work there. And that separation is powerful. It gives you limited liability, meaning the company itself can own things, owe money, but generally the financial risk to the shareholders, the owners, is limited, usually just to the amount they've actually invested. Their personal assets are typically safe. And you can find all the details about a company who runs it where it's based publicly registered at Companies House. Their powers, what they can and can't do, are set out in documents like their memorandum and articles of association.
Okay. And then there are partnerships, so they sort of feel like they sit somewhere in the middle.
Yeah, they're unique. A partnership is basically an arrangement. Two or more people, the partners, agree to pool resources, share profits. But crucially, like a sole trader, a traditional partnership is not a separate legal entity from the partners themselves.
So liability.
Liability is key. Partners are often jointly and severally liable for the business's debts.
What does jointly and severally mean in plain English?
It means creditors can pursue all the partners together, jointly, or they can go after just one partner for the full amount, severally. So if your partner messes up and racks up a huge debt,
You could be personally liable for the whole thing, even if it wasn't your fault.
that's the risk, yes. Significant personal exposure there.
Okay. But then there's this other thing, this hybrid. Limited liability partnerships. LLPs, how do they fit in?
Right, LLPs. They're a fascinating blend, really trying to get the best of both worlds. With an LLP, the partners do get limited personal liability, much like shareholders in a company. Their risk is usually capped at whatever they've put into the partnership. They're also registered at Companies House, just like companies.
So they're like companies then.
Not quite, especially when it comes to tax. This is the clever bit. LLPs are not subject to corporation tax. Instead, the individual partners are taxed on their share of the profits as if they were self-employed, similar to sole traders or traditional partners.
I see. So liability protection like a company, but taxed like a partnership.
Exactly. It offers that balance. Protection, but maybe a simpler tax structure for the partners involved.
So the big picture here for you listening.
Mm-hmm.
If you're starting a business, choosing the structure isn't just admin. And even if you're just dealing with a business, buying from them, working for them, understanding whether it's a sole trader, partnership, LLP, or company, tells you a huge amount about who's ultimately responsible if things go wrong. Like, step one in understanding the financial risks.
Absolutely. Fundamental.
Right. Now, let's shift gears to something we all encounter constantly. Contracts. We sign them for phones, for renting a flat. We click I agree online dozens of times.
Yeah.
But what actually makes a contract, stick?
Yeah.
What makes it legally binding?
Ugh, the magic ingredients. Yeah, for a contract to be truly binding, legally enforceable, there are 6 essential requirements. If even one is missing, the whole thing can potentially fall apart. Okay, first. Offer and acceptance. Someone makes a clear offer and the other party accepts it exactly as it is, unqualified acceptance. And a key point here, something people often miss, if you make a counteroffer like, I'll buy it, but for £10 less, that actually rejects the original offer. You can't then change your mind and go back to the first price.
Okay, offer and acceptance. Got it. What's next?
Second, consideration. Now, this isn't about being nice. In legal terms, consideration means there has to be an exchange of value. Both sides must promise to give something, money, goods, a service, whatever. It's the what's in it for me on both sides. Without that mutual exchange, it's usually just considered a gift or a casual promise, not something a court will enforce.
Makes sense. What's number 3?
Third is capacity to contract. Basically, do the parties involved have the legal ability to make a contract? Generally, this means being over 18 and having the mental capacity to understand what you're agreeing to. And for businesses, especially financial ones, their capacity often comes from being authorized by regulators like the FCA or the PRA here in the UK.
Okay, capacity. Halfway there.
Fourth, the contract terms themselves. They need to be clear, complete, and unambiguous. You shouldn't have to guess what you're agreeing to. If it's too vague, it might not hold up.
Right, certainty. Avoids arguments later.
Exactly. Fifth, there has to be an intention to create a legal relationship. This separates formal agreements from, say, casual social arrangements. If you agree to meet a friend for coffee and they don't show up, you wouldn't sue them, right? There was no intention for that promise to be legally binding.
Okay, intention. And the last one.
Finally, sixth, legality of object. The purpose of the contract can't be illegal or against public policy. You can't have a binding contract to commit a crime, for instance.
So those are the 6 pillars. Offer acceptance, consideration, capacity, clear terms, intention, and legality.
That's the core framework.
But even if all 6 are technically there, I seem to remember there are things that can still sort of poison the well, make a contract invalid.
Absolutely. Things like misrepresentation, where someone tells you something false to get you to agree, or duress, being forced or threatened into signing, or undue influence, where someone in a position of trust pressures you. These can all potentially allow you to get out of a contract.
Right. And speaking of misrepresentation, that leads us to disclosure, doesn't it? What you have to tell the other party.
Yes, disclosure of information. The general starting point in English contract law is caveat emptor,
Which means?
let the buyer beware. Traditionally, the burden was on the buyer to ask the right questions and do their homework. If you didn't ask, the seller didn't necessarily have to tell you unless they actively misled you. Think buying a used car, you're expected to check it over.
Okay, buyer beware. But there are exceptions.
Oh, yes. A massive one is insurance contracts. They operate under a completely different principle called uberrima fides.
Utmost good faith. Sounds important.
It is. It historically meant that you, the person buying insurance, had a duty to volunteer all material facts to the insurer, anything that might influence their decision to offer cover or set the price, even if they didn't specifically ask you about it.
Wow, that sounds quite tough on the consumer. You might not even know it's material. Didn't that cause problems? I feel like I remember hearing about claims being rejected for things people forgot to mention.
You're right, it did. It felt unfair sometimes, especially if the non-disclosure was accidental. That led to a big change with the Consumer Insurance Disclosure and Representations Act, 2012. This act shifted the balance significantly for consumers. Now, instead of having to guess what to volunteer, your main duty is to take reasonable care to answer the insurer's questions honestly and accurately.
So the onus is more on the insurer to ask the right questions now.
Pretty much. They need to ask clear, specific questions. If you answer honestly based on what you know, you're generally covered. The law now protects you more if you make an honest mistake. If your non-disclosure was genuinely innocent or reasonable, the insurer usually can't refuse your claim just for that. However, if you were careless, they might adjust the claim payout. And if you deliberately or recklessly misled them, then yes, they can still reject a claim entirely and keep the premium you paid.
Okay, that seems fair. So, let's say a contract is valid, all elements are there, but one side just doesn't do what they promised. A breach of contract. What happens then? What can you do?
Right, remedies for breach. The most common remedy is damages. This is usually about money. The court tries to calculate a sum of money that would put the innocent party back in the financial position they would have been in if the contract had been performed properly. It's about compensating for the loss suffered.
So, making good the financial damage. Are there other options besides money?
Yes, sometimes money isn't enough or isn't appropriate. A court might grant an order for specific performance. This forces the breaching party to actually do what they promised in the contract. This is rarer, usually only used when the subject of the contract is unique, like a specific piece of art or land. You can't just get damages and buy an identical replacement.
Okay, forcing them to go through with it. Anything else?
There's also an injunction. This is a court order stopping someone from doing something. For example, if someone breaches a non-compete clause in an employment contract by going to a rival, the court might issue an injunction to stop them working there.
Right, so damages, specific performance, or an injunction, different tools for different breaches. It really makes you think, doesn't it? About all those times you click agree or sign on the dotted line. Did you actually check for those 6 key ingredients? Understanding this stuff really helps you spot the critical bits in any agreement. It's like having the X-ray specs for legal documents. Gives you much more confidence.
Absolutely. Knowledge is power here.
Okay, next up. What happens when someone acts for you? You give someone permission to do something on your behalf. Maybe it's your financial advisor or an estate agent selling your house. This whole area is governed by the law of agency.
That's right. Agency law is all about the relationship between 2 key parties. You have the agent, that's the person who's authorized to act, and the principal, that's the person who gives the agent the authority to act on their behalf. So in your examples, the financial advisor is the agent, and you, the client, are the principal. The estate agent is the agent for the person selling the house, the principal.
Simple enough, but I bet it gets complicated.
It can. One really important and sometimes tricky concept is called apparent authority, or sometimes ostensible authority. This is where an agent might not have actual authority. You didn't explicitly tell them they could do something. But based on the principal's actions or words, a third party reasonably believes the agent does have that authority.
How does that work in practice?
Well, imagine you run a business and you let one of your employees negotiate and sign small contracts for years, even though their job description doesn't formally say they can. If that employee then signs a bigger contract with a supplier who has always dealt with them before, you, the principal, might be legally bound by that contract even if you didn't specifically authorize that particular deal. Why? Because your past behavior led the supplier to reasonably believe the employee had the authority to act for you.
Ah, so your actions can accidentally give someone authority you didn't intend.
Exactly. It binds the principal, because it would be unfair to the third party who relied on that appearance of authority.
That's a bit scary. What if an agent does something completely outside their authority? Maybe something you wouldn't have agreed to, but it turns out okay. Maybe they got a great deal.
Ah, that leads us to another concept. Ratification. If an agent acts without authority, or exceeds the authority they were given, the principal finds out later. If the principal likes what the agent did, they can choose to ratify the action. Ratification means you retrospectively approve the unauthorized act. It makes the contract valid as if the agent had authority all along. It's like giving it your official blessing after the fact.
So you can adopt their actions if you want to.
Yes, but you don't have to. If you don't ratify, generally you're not bound by the unauthorized act.
This whole agency thing really makes you think, doesn't it?
Yeah.
When you ask someone to act for you, an advisor, an employee, anyone, how much power are you actually handing over? And how much responsibility do you end up carrying for what they do? It's a crucial relationship dynamic.
Very much so. Clarity about authority is vital.
Okay, let's move on to something deeply personal. Our assets, our property, and planning for the future. We're talking about property ownership, powers of attorney, and wills, really the building blocks for protecting your legacy, that invisible architecture we mentioned.
Absolutely. And when the law talks about property, it generally makes a distinction between 2 main types. First, there's realty. This is basically immovable property, land, buildings, anything fixed to the land, your house, an office block, a field. Second, there's personality. This covers pretty much everything else you own that isn't land or buildings. So your car, bank accounts, shares, furniture, jewelry, all your movable stuff.
Okay, realty and personality.
Right.
And within realty, How we own property with others is really important, isn't it? Especially jointly owned homes.
Hugely important. There are two main ways to jointly own property in England and Wales, and the difference has massive implications, especially when someone dies. First, you can own as joint tenants. Think of this like you and the other owners owning 100% of the property together, undivided. There aren't separate shares. The crucial feature of joint tenancy is the right of survivorship. When one joint tenant dies, their ownership interest automatically vanishes, and the surviving joint tenants automatically own the whole thing.
Automatically, so it doesn't matter what their will says.
Doesn't matter at all. The property passes outside of the will and outside of the rules of intestacy if there's no will. It goes straight to the survivor.
Wow. Okay. What's the alternative?
The alternative is owning as tenants in common. In this case, each owner holds a distinct, defined share of the property's value, maybe 50-50, 70-30, whatever is agreed. Crucially, there's no right of survivorship. When a tenant in common dies, their specific share does not automatically go to the other owners. Instead, that share forms part of their estate and will be passed on according to their will or under the intestacy rules if they don't have a will.
Okay, that's a huge difference. Let's make that real. Say Sarah and Tom buy a house together. If they're joint tenants and Sarah sadly dies, Tom automatically gets the whole house. Sarah couldn't leave her half to her kids in her will.
Correct.
But if they bought as tenants in common, each owning 50%.
Yeah.
If Sarah dies, her 50% share goes to whoever she named in her will. Maybe her kids, maybe Tom, maybe someone else. Or if no will, it follows intestacy rules. Tom only keeps his original 50%.
Precisely. Tenants in common gives you control over where your share goes after your death. Joint tenancy offers simplicity for the survivor, but less control over inheritance.
Very important distinction for anyone buying property together. Now, shifting gears slightly. What happens if someone becomes unable to manage their own affairs? Maybe due to illness, like dementia, or even just being stuck abroad for a long time. This is where power of attorney comes in, right?
Yes, a power of attorney is a legal document where one person, called the donor, gives another person, the durney, or the attorney, the authority to make decisions and act on their behalf. It's incredibly useful for planning ahead, especially for potential loss of mental capacity.
Are there different kinds? I feel like I've heard different terms.
There are, and the rules have changed over time, which can be confusing. You used to have what's called an ordinary power of attorney. This is often used for temporary situations, like if you're going abroad. But crucially, it automatically becomes invalid if the donor loses mental capacity. So not great for long-term planning for illness.
Okay, so that's limited.
Right.
What else?
Before October 2007, you could create an enduring power of attorney, or EPA. The key feature of an EPA was that it could continue even if the donor lost mental capacity. However, once the attorney believed the donor was losing capacity, they had a duty to register the EPA with the Office of the Public Guardian, the OPG. That's the government body overseeing these things.
And EPAs created before 2007 are still valid if they were done correctly.
Yes, they are, but you can't make new ones.
So what replaced them?
Since October 2007, we have lasting powers of attorney, or LPAs. These have completely replaced EPAs for new arrangements. A critical difference with LPAs is that they must be registered with the OPG before they can be used at all, even if the donor still has capacity. Registration is upfront.
Okay, register first. Are there different types of LPA?
Yes, two distinct types, and you can choose to have one or both. There's an LPA for health and welfare. This allows your chosen attorney to make decisions about things like your medical treatment, where you live, day-to-day care. It can only be used if you've lost capacity to make those decisions yourself. Then there's an LPA for property and financial affairs. This lets your attorney manage your money, pay bills, collect benefits, manage investments, even sell your property. This one can be used while you still have capacity, if you wish, perhaps if you find managing finances difficult.
So you need to think carefully about who you appoint and which powers you grant.
Absolutely. Choosing your attorneys is a huge decision.
What happens if tragedy strikes, someone loses capacity, and they haven't made any kind of power of attorney? That sounds like a potential nightmare for the family.
It really can be. Without an LPA or a valid EPA, no one has automatic legal authority to manage that person's affairs. Bank accounts can be frozen, bills unpaid. In that situation, someone, usually a family member, has to apply to the Court of Protection. This court has the power under the Mental Capacity Act 2005 to make decisions for people who lack capacity, or to appoint someone, called a deputy, to manage their affairs on an ongoing basis.
But that sounds like it could be slow, expensive, and stressful. And you might not get the person appointed that the individual would have chosen.
All of the above. The court process is much more complex, costly, and time-consuming than setting up an LPA in advance. It really highlights the benefit of proactive planning.
Okay, that leads us naturally to the final piece of this personal planning puzzle: wills and estates. Planning for what happens after you're gone.
Yes, a will. It's simply a written declaration setting out who you want to inherit your assets, your estate, after your death. And its importance is huge when you hear the statistic that something like 7 out of 10 people in the UK still die without a valid will.
7 out of 10. That's incredible. Why is having a will so important?
Because without one, you don't decide who gets what. The law decides for you, according to strict rules called the rules of intestacy. And those rules might not reflect your wishes at all. A will puts you in control. It ensures your assets go to the people and causes you care about. It can appoint guardians for your children. It can help with inheritance tax planning. And importantly, it can prevent disputes and heartache among your loved ones later on.
Which is why financial advisors are always recommending people make one. It's a cornerstone of financial planning.
Absolutely.
Are there specific rules for making a will valid? It's not just jotting something down, is it?
No, there are strict legal formalities that must be followed under English law. It generally must be in writing. The person making the will, the testator, must be 18 or over and have mental capacity. And critically, it must be properly signed by the testator in the presence of 2 witnesses, who both also sign it in the testator's presence. And a really important point: the witnesses or their spouses or civil partners cannot be beneficiaries in the will. If they are, they usually lose their inheritance.
Okay, in writing, signed, 2 witnesses who aren't benefiting. Got it. So, after someone dies, how does the estate actually get distributed?
It depends on whether there's a valid will. If there is a valid will, the person named in the will to carry out the instructions, the executor takes charge. Their first job is usually to apply to the court for a grant of probate. This grant is the official proof that the will is valid and gives the executor the legal authority to gather the assets and distribute them according to the will's instructions.
Okay, executor gets probate. What if there's no will?
If there's no will or the will is invalid, the person dies intestate. In this case, the court appoints someone, usually a close relative, to manage the estate. This person is called an administrator. The administrator has to apply for letters of administration, which is the equivalent of probate for intestacy. This gives them the authority to distribute the estate, but they must follow the strict intestacy rules.
And those intestacy rules, they lay out a very specific pecking order, don't they?
They do. It's a rigid hierarchy based on family relationships. For example, if the deceased was married or in a civil partnership with children, the spouse gets all the personal belongings, chattels, the first £322,000 of the estate value, and then half of whatever is left over. The children share the other half of the remaining amount. If there's no spouse but there are children, the children inherit everything equally. If no spouse and no children, it goes to parents, then siblings, then more distant relatives in a specific order.
And if there are absolutely no blood relatives who can be traced?
Then ultimately the entire estate passes to the crown. Bona vacantia, as it's known. The government gets it.
Wow. Really highlights the need for a will if you want any say in the matter.
Absolutely.
Now, I've also heard about something called a deed of variation. Can you explain what that is? Can you actually change a will after someone has died?
Yes, you can, surprisingly. A deed of variation is a legal document that allows the beneficiaries named in a will, or those entitled under intestacy, to effectively rewrite the distribution of the estate after the person's death. All the beneficiaries affected by the change must agree, and it generally needs to be done within 2 years of the death, although for tax purposes often it's 6 months. People might do it to redirect an inheritance to someone else who needs it more, perhaps skip a generation, or sometimes for inheritance tax planning reasons. It allows the family to adjust the inheritance based on current circumstances.
That's a really useful tool for flexibility.
It can be, yes.
So, wrapping up this section, wills, powers of attorney, understanding property ownership. This is where that invisible architecture really becomes visible, isn't it? Planning for these things gives you control, protects your loved ones, and saves a massive amount of potential stress and costs down the line. It's about taking charge of your own legacy.
Couldn't agree more. Essential planning.
Okay, finally, let's touch upon a few more crucial areas. Managing assets for others through trusts. What happens when things go financially wrong with insolvency and bankruptcy? And very importantly, protecting yourself from scams.
Right, let's start with trusts. A trust, sometimes called a settlement, is a really clever legal mechanism. It allows someone, the settler, to put assets aside for the benefit of other people, the beneficiaries, but without giving those beneficiaries outright control of the assets yet. The assets are legally owned and managed by trustees according to rules set out by the settler in a document called the trust deed.
So let's use that example again. George, 85, wants £500 K to go towards his grandkids, Chloe and Mark's education, but maybe not until they're, say, 21.
Exactly. George could be the settler. He transfers the £500 K into a trust. He appoints trustees, maybe himself, maybe a solicitor, maybe other family members. The trust deed would specify the money is for Chloe and Mark's benefit, perhaps outlining when and how they can receive funds. The trustees legally own the money, but they have strict duties.
What kind of duties?
Their fundamental duty is to act in the best interests of the beneficiaries, always following the terms of the trust deed. They need to manage and invest the trust assets prudently, often taking professional advice, keeping proper accounts, and regularly reviewing the investments. They hold a position of significant responsibility.
Okay, so trusts are a way to control assets for others. Now, what about when individuals or companies face serious financial trouble? Insolvency and bankruptcy.
Right. Insolvency is essentially the state of not being able to pay your debts when they fall due or having liabilities that outweigh your assets. It's the financial condition. Bankruptcy is the formal legal process that can happen to an individual who is insolvent. It's usually triggered if you owe £5,000 or more. If you're declared bankrupt, control of your assets passes to an official receiver or trustee who sells them off to pay your creditors as much as possible. Bankruptcy typically lasts for 12 months.
And the consequences are pretty severe, right? Affects your credit rating, ability to run a company.
Oh, absolutely. Getting credit becomes very difficult for years afterwards. It can affect certain jobs. You generally can't act as a director of a limited company while bankrupt. It's a serious situation with long-lasting effects.
Are there ways to deal with serious debt without going bankrupt?
Yes, there are alternatives designed to be less harsh and potentially allow for recovery. For individuals, there's the Individual Voluntary Arrangement, or IVA. This is a formal, legally binding agreement between an insolvent person and their creditors to repay debts over a set period, often 5 years. You make regular payments, often reduced amounts, and creditors agree not to take further action. It requires agreement from creditors holding at least 75% of the debt value. Crucially, unlike bankruptcy, your assets aren't usually automatically taken, and it offers legal protection while you repay.
Okay, so an IVA is a structured repayment plan. Is there something similar for companies?
Yes, the company equivalent is called a Company Voluntary Arrangement, or CVA. It allows a company that's insolvent but potentially viable to make a formal agreement with its creditors to repay its debts over time, perhaps allowing it to restructure and continue trading. Again, it needs creditor approval. It's a rescue mechanism trying to avoid liquidation if possible.
Right, trying to keep the business afloat. Okay, lastly, and this is something that unfortunately touches so many people's lives, scams. They seem to be everywhere and getting scarily sophisticated.
They really are, and financial advisors have a really important role here, not just in giving advice, but also in helping clients spot red flags and avoid falling victim to investment or pension scams. The regulator, the FCA, also runs the Scam Smart website, which is a very useful resource for anyone. It helps you check if an investment opportunity is known to be suspicious and gives tips on how to protect yourself.
It feels like the scammers are always one step ahead sometimes.
It can feel that way. What's interesting, though, is seeing how bodies like the Financial Ombudsman Service are reacting. They seem to be setting a higher bar for banks, expecting them to do more to protect customers. If a bank perhaps missed obvious warning signs when transferring money for a customer who's being scammed, the Ombudsman is increasingly finding the bank might bear some responsibility. We've also seen rulings from the Pension Ombudsman, for example, suggesting that pension providers or advisors who didn't do proper due diligence checks before allowing a transfer to a scam scheme might actually have to compensate the victim.
So the responsibility is slowly shifting, maybe. More onus on the professionals and institutions to protect people.
It seems to be moving in that direction, yes, recognizing the sophistication of modern scams and the vulnerability of consumers.
So understanding these legal frameworks, trusts, insolvency options, even the regulatory pushback on scams, it's not just abstract legal theory. It's about real-world protection for your money, your assets, and your future. Knowing your rights and where the safety nets are.
Exactly. Practical protection.
So there we have it. We've covered a lot of ground from the basic idea of a legal person, through business structures, the nuts and bolts of contracts, how agency works, planning your legacy with property, wills, and powers of attorney, and finally touching on trusts, insolvency, and scams. What does this all mean for you? Well, from the moment you buy that coffee, sign that contract, think about starting a business, or plan for your family's future. These legal concepts are working away in the background. They're the invisible architecture of your financial life. Knowing them doesn't just make you sound smart. It genuinely empowers you. It helps you ask the right questions, understand the risks, protect yourself, and navigate the complexities of modern life with a lot more confidence and foresight. So maybe the question to leave you with is, knowing what you know now, what parts of your own financial life will you look at a little differently? What foundations will you check?